Wendy Myers, head of Securities at PSG Wealth, who's been taking us on a journey of how to invest. And last week we touched on when to sell, very important, just as important as when to buy. Wendy, welcome. This week we're going to be exploring the right strategies when it comes to exiting a position in your portfolio and what investors should bear in mind. And I think in the context of investing, it's really important to understand not just what stocks to buy to ensure that you achieve your long-term investment goals, but the different ways to evaluate portfolio performance and then how the decisions taken on corporate actions impact this portfolio performance. And I think we tend to talk a lot about portfolio performance at a headline level and the need to focus on long-term goals. So how should an investor calculate investment returns?
Yes, thank you, Michael. I think there's quite a bit of science to it, but I think you can simplify as an investor understanding how to evaluate your portfolio. And it's really important to understand what's best for you because it obviously sets us up for future investment success. So there's different ways of looking at it. I mean, you can look at a single investment calculation. This obviously provides insight into that particular individual stock and the performance of that stock. You'll remember last week we spoke about how when you assess when to sell a share and specifically NVIDIA and how that's been raging ahead over the last couple of months. So it's important to be able to understand that you need to be able to assess the performance of individual asset within your portfolio. And then you can decide, is it a profitable investment? Is it underperforming? And whether or not you need to take action on it. But really, ultimately, we would focus on the full portfolio and evaluating the portfolio return, because that obviously means you are able to assess whether your overall investment strategy is being achieved and if you're on your way to achieving your goals and making sure that you're diversifying. So you need to look holistically. And there's two ways really to do that. There's the time-weighted return, which is personally my favorite. And then there's the money-weighted return. And these are very standard methods of calculating your portfolio return, which any platform that offers you to invest should provide that to you. The time-weighted return really helps you focus on the portfolio's investment performance, whereas money-weighted return, that is typically something that considers the amount and timing of individual cash flows. Time-weighted return is my favorite because it removes the impact of those cash flows and it provides a far more accurate measure of the effectiveness of your investment manager, if you've got a financial manager, or of yourself, your track record from investing. So it's really, time-weighted is really helpful because it assists you in evaluating your investment strategy. And then obviously, especially if you regularly contribute to your portfolio, withdraw from it, it removes that noise. And I think that's an important understanding for investors to have. And then I think once you've defined your appropriate method, it's just a good idea to set a benchmark. I mean, it's all very well thinking you've done quite well. You're up 10% in your portfolio, but really if the market's up 25, well, then you've done quite badly. And actually, if you're up 10%, but the market's down 5, you've done exceptionally well. So to me, defining a benchmark and then linking that to your portfolio is important. What I do also want to reiterate is it's important to choose the benchmark that matches your portfolio makeup. So you don't want, if you have a balanced portfolio, you don't want a very tech-focused benchmark because otherwise you're not comparing apples with apples. So maybe that's something we can unpack in another session, Michael, but that's definitely something that investors should consider once they've chosen their way of investing their portfolio, their method.
I think that's a great idea for a future conversation. You know, how are indices calculated, compiled? And because very often you're looking at an index against which you will benchmark this kind of performance. And, you know, depending on what your investment goals are, as you say, are you drawing down an income and not reinvesting some of those dividends perhaps. And that's why that'll impact a money weighted versus a time weighted measure, which strips a lot of that noise out of the system. So now that we understand how the best options to measure performance work, let's look at just unpacking the difference between dividends received versus corporate actions. And I think often this is where a lot of the jargon can trip a retail investor up, and it can impact your portfolio differently in the long term when considering your performance. So let's look first at defining the various types of corporate actions and what this means to investors.
Yes, absolutely. So I think it's important. Obviously, the savvy investor knows that when a listed company announces a corporate event, it's going to impact the stock price. So, if you're a shareholder or you're considering buying shares in that company, you need to understand how that event will impact the stock's price. A corporate action can indicate a company's financial health. It can indicate prospects for the near term. Corporate actions can be voluntary when investors need to choose to participate, or they can be mandatory, like a cash dividend. And that means that participation is an obligation. You have to participate. Examples of corporate actions, they're very wide ranging, Michael, and sometimes can be quite daunting. So I think it's important for us to spend a bit of time unpacking the different definitions.
Yeah.
You get things like stock splits. You get dividend distributions. Dividend distributions can be in the form of either a stock that the investor receives, so more their shareholding increases, or they get cash dividends. Corporate events can also include mergers and acquisitions. They can include rights issues. They can include contingent value rights, which is a new term some of the Steinhoff investors would have recently been exposed to. And these are this was used in the recent Steinhoff liquidation. Spin-offs is where a company is delisted, or it's removed from the holding company, and that's seen as a spin-off. So maybe that particular holding of the holding company is going on a different trajectory, and so there you go. That's a classic example that is coming out of Transaction Capital, and it's having its own listing, which I think is extremely exciting for the local market. Yeah. And then you have quite basic events like a name change or a ticker change. Remember, a ticker change will be FSR for First Rand. And then another corporate event is a liquidation. So it's important for the investor to understand what, if this happens, if there's an announcement by a listed company of a corporate action, what does that mean for me? Yeah. If I'm an existing shareholder, or if I want to consider buying into that stock. So one of the common dividends or corporate events are obviously distributions, and I've spoken about that, and it impacts your portfolio in that you could get cash coming into your portfolio, which is fantastic because it means you can increase your investments into the market, or you can leave it in cash, depending on your view. We spoke about that last week. And then there's some companies that actually do a dividend distribution in the form of a stock and not cash. And obviously, you will know that will increase your exposure to that particular share, and you've got to be comfortable with that. And you've got to consider that impact in when you look at your balanced portfolio to say, well, what does that mean for me? Yeah. Does it make me too exposed to a retail stock or a banking stock, as an example?
Yeah.
Sorry, Michael.
No, I was just going to say concentration. It comes back to what we were discussing a couple of weeks ago around diversification and balance in one's portfolio. And often because of these corporate actions, it can throw that balance that you've worked hard at achieving out. So this is also why, when we look at the question of how often we should revisit our portfolio, often it's also guided by the various corporate actions and why this is really the active component of managing your portfolio. Often as a long-term investor, you've made your decisions, you're back in the management teams, you want to let it run. And they always say it should be like watching paint dry. But because of these corporate actions, you do have to be quite active in overall managing the portfolio. The interesting corporate action that we've seen recently was around share splits, isn't it? Haven't we heard that NVIDIA, and to your earlier point, is considering a share split now as well?
Correct. Yeah, and I think maybe a year ago, Google and Amazon that haven't done any corporate actions for a long time, they did a share split. Yes. And that, I think what was what was material about those ones, I think it was something like 20 to 1, the split. And it meant that your holdings were times by 20, but it meant that the share price obviously dropped materially. And what that does is it gives the ability for other investors to invest in the stock because it's a bit more affordable. So that's a big reason why these sort of tech giants look to do this. So it's not just more affordable, then it makes it more tradable. So that's seen, in my opinion, it's been a very good move by those two tech giants, and definitely why NVIDIA would be considering it now, I think, given its meteoric rise. Yeah. Spin-offs that we've spoken about, Michael, that's the topical one is We Buy Cars that you just mentioned. And that's really to try and get value out of that particular asset. So maybe the holding company, Transaction Capital, if you've been following it, has seen really some very downward movements in their share price. And what they're trying to do is get value out of that particular division of their holdings, because the current Transaction Capital share price is so undervalued. So for them to spin off We Buy Cars, I think is an extremely very good decision. And I think it's certainly a stock that I'm adding to my watch list to see how it performs.
Yeah, I think it's a great business. I recall interviewing the founders a couple of years ago, Fan and his brother, and it's highly cash generative. If you've ever used the We Buy Cars service, as I have, it's an absolute dream in terms of the user experience. They add all kinds of different products, finance and insurance and that kind of thing. I don't know quite whether or not Fine is a big, enthusiastic supporter of that. I know that was big for Transaction Capital, but I think overall, I couldn't agree with you more. Very interesting. I think that'll be on the 11th of April. And finally, another listing on the JSE. And so, we can push back against all of these delistings trends, which takes me
Exactly.
mergers and acquisitions. I mean, M&A is almost the lifeblood of what drives listed companies. We often see big deals announced, acquiring maybe a competing firm if the competition authorities will allow you. What's important to bear in mind here when it comes to M&A?
Well, I think, to me, it's also mergers and acquisitions is definitely a sign of the health of an economy. Mergers obviously occur when two or more companies combine, and merging, obviously they've got like-minded strategies and they want to benefit from a merged entity. And obviously that takes a lot to get to that level where all parties agree to the terms. And then I think, obviously one of the companies will surrender its stock to the other. So that's an important impact that the investor needs to understand, because more than likely their investment will go from owning the one, it'll be a complete name change, and they'll own the company that's taken over the smaller one. And I think, when you consider an announcement by a company of a takeover, you need to really unpack it in two ways. Either it's a strategic move for business expansion, and that's obviously very positive for your portfolio, or maybe that the industry is consolidating, and maybe that you need to watch that stock quite carefully, and maybe it's it's something that you want to reduce your exposure to. Maybe the company is able to absorb competitors and maintain growth. That's another positive that could come out of it. So there's different ways of looking at M&A from an investor perspective and whether it'll benefit your portfolio.
Yeah, again, why it's so important to be actively engaged in this. And then when it comes to trading or changing a ticker name, and again the jargon in the industry, it's a ticker because it's in the old days that used to tick up on the board on those open outcry exchanges, and not really relevant to the digital world. We still call it a ticker, but why do companies tend to change their names?
Well, I think they feel that the name change, their previous name, think of Facebook, it's moved away from just being where it traditionally started. Yeah. So they've changed their name to Meta. So they believe that the company's evolved into a much bigger space. It's not just around where they originally started. Yeah. So to me, it highlights that the company has matured. It's expanded into other areas. So I think that's a very positive thing. I think a name change, it doesn't impact your portfolio from a performance perspective, but it might give you some insight into how diversified the company has become, and also a reflection on where it's going from a strategic perspective. Maybe it's going to delve into different markets, and its name doesn't relate to that anymore, so it needs to rebrand, as it were.
Often an indication of strategic pivoting or evolution. So how do the different corporate actions then impact my tax liability? Because tax can be extremely complicated when it comes to managing these kinds of things. And to a lot of our earlier points, often why it's important to have sound financial advice when you're approaching or dealing with these different corporate actions.
Yeah, absolutely. I think it's important for investors to understand that you can't look at your performance without considering tax, unfortunately. Cash dividends, we've often spoken about. They are required to be incorporated into your tax return. Investors are charged withholding tax on cash and stock. So don't think because you're receiving stock that you're not going to be charged withholding tax on that. And then I think, in the case of a merger, if you're receiving shares of the acquiring company, you may face a capital gain. So it may trigger a sale event for you, and that's going to result in you having to pay capital gains tax on that event, which you need to make sure you've got the cash available to fund that tax. But I think financial advisors can definitely help you provide the more holistic guidance when it comes to individual corporate actions and how it impacts your tax return. Just remember, though, financial advisors aren't as close to tax as tax professionals. They can guide you, but the tax professional is the licensed professional that gives you really insightful views as to how to manage your investments and the tax considerations around corporate actions.
Right. So I would first go to a tax professional, to be honest, on that one. Absolutely. So in summary, what does all of this then mean for investors? Sum it up for me.
Well, I think, we've spoken about performance and how to evaluate it. And I think it's important for investors to really consider the activity that happens in the market in the form of corporate actions and how it impacts your portfolio, how it impacts the company's prospects. You can read a lot into the event and take stock of what's happening and consider what does it mean for the company's future? What does it mean for the company's share price? And you need to be, to your point, Michael, be active, be aware of what's happening in the market. How will it impact your portfolio? Obviously, you don't want to be so active that it results in you triggering buys and sells all the time. I think you still need to be disciplined in your approach and have your long-term view. But I think it's important for investors to really understand, how is my investments holding up in the context of my investment goals, and these corporate actions. What are they doing to make sure that I achieve those goals?
And it's also an opportunity to sit down, isn't it, with your financial advisor when a corporate action appears to help you consider what action to take.
Yeah, very much so. I mean, the Steinhoff corporate action, it's been a very painful one for investors. And, understanding the liquidation impact and what does it mean, it's very important to sit down with your financial advisor to make sure that even something that actually was quite a painful experience for those impacted investors, most platforms were able to pay funds back to investors. And, I think it's important for investors to be fully aware of their rights there. And I think just in summary, just understand how your portfolio is impacted by these events and make sure you define your benchmark. Make sure you understand that how your portfolio is performing in relation to that relevant benchmark that you've defined. Interpret a corporate action. Don't just sit on the sideline. Really make sure you understand if you are given the option for an elective event. Make sure you understand what is important between opting for cash or opting for stock and the different tax consequences. And then I think, I think it's important to consult a tax professional. To your point, Michael, It's not something that you can do on your own, and you'll feel more confident if you have that guidance when you make that decision of that corporate event. So that ultimately, you can be rest assured that you know that you've taken the right course of action for your risk profile.
And often I think this is really the fun part of investing is being an owner, because ultimately buying a stake in a company is what you're doing as a shareholder. You're an owner. You're interested in what that company is doing from a corporate action perspective. Is it doing deals? Is it consolidating? Is it coming to market to ask for money in a rights issue and capital raise? What's going on? Why? Is it paying great dividends? All of these things are really why I love investing, and why we're investors for the long term, and not just trading stocks. Trading is great. If you're a day trader, I'm sure you can make a lot of money. But as an investor, this is really what gets me excited about markets. So Wendy Myers, thank you very much, Head of Securities at PSG Wealth, as always, for making it sound so simple. You really do. Thanks for your time.
Thank you, Michael.